Right now, while politicians celebrate a booming economy and Wall Street hits record highs, one of the most accurate recession predictors in history just flashed its brightest warning signal in over 2 decades. This indicator has correctly predicted every major economic downturn since 1969, including the 2008 financial crisis, the dot-com crash, and even the 1970s recession that destroyed millions of jobs. But here's what's terrifying. Most people have never heard of it. But get this. The warning isn't coming from where you'd expect. Because while everyone's watching the stock market and unemployment numbers, this silent alarm is screaming from inside America's trucking industry. And what it's revealing about our economic future will shock you. If you want to know what's really happening to the American economy and why even seasoned economists are quietly preparing for the worst, hit that like button and subscribe to FinSight Capital. We expose the financial truths that mainstream media won't tell you. Stay until the end, because I'll reveal the exact timeline when this recession indicator suggests the economic collapse will hit. And it's closer than you think. Meet Sarah Chen, a third-generation trucking company owner from Ohio. Her grandfather started Chen Logistics in 1967 with a single truck and a dream. By 2019, the company operated 47 trucks and employed 89 people across 3 states. Sarah had expanded the business through 2 previous recessions, the 2008 financial crisis and even the COVID pandemic. In March 2024, she was forced to auction off her entire fleet. I've been in this business for 23 years, Sarah told me during our phone interview, her voice breaking. I survived everything the economy could throw at us. But this time is different. The numbers don't make sense anymore. Sarah's story isn't unique. It's happening thousands of times across America, creating the most devastating trucking recession in modern history. But here's what makes this terrifying. Trucking downturns have predicted every major economic collapse with frightening accuracy. Let me show you exactly what's happening right now. The American Trucking Association reports that over 8,000 trucking companies have filed for bankruptcy since January 2023. That's not over several years, that's in just 18 months. Small family operations, mid-size regional carriers, and even some major freight companies are disappearing at a rate that's making industry veterans physically sick. Yellow Corporation, a 99-year-old trucking giant, shut down overnight in July 2023, laying off 30,000 employees. Convoy, the $3.8 billion Uber for Trucks startup, collapsed without warning in October 2023, stranding drivers across the country. Motor Transport Services, Matheson Trucking, Falcon Transport. The list of closures reads like an economic obituary. But the real devastation is happening to people like Mike Rodriguez, a 34-year-old owner-operator from Texas. He'd invested his life savings, $180,000, into a brand-new Peterbilt truck in 2022, dreaming of building his own logistics empire. I was getting $350 per mile in 2021, Mike explained during our conversation. By 2024, I was fighting for loads, paying $120 per mile. Do you know what it costs to operate a truck? Fuel, insurance, maintenance, loan payments. I was losing money on every single load. Mike lost his truck to repossession in February 2024. He's now working at a warehouse for $17 an hour, trying to rebuild his life while dealing with the depression of watching his American dream get crushed by forces completely beyond his control. Here's the number that should terrify every American. Freight rates have collapsed 35% in the past 2 years, while operating costs have increased 28%. That's not a market correction. That's an industry death spiral. Therefore, trucking companies are caught in an impossible squeeze. They can't raise prices because customers are demanding cheaper shipping to combat inflation. They can't lower costs because fuel, insurance, and equipment prices keep rising. And they can't reduce capacity because they've already fired everyone they can. But this creates a much bigger problem than just trucking bankruptcies. Because what most people don't realize is that trucking downturns are the economy's most reliable early warning system. And right now, this warning system is screaming louder than it ever has before. Let me show you exactly why this matters to every single American. In 1969, Dr. Martin Friedman at the Federal Reserve Bank of Philadelphia made a startling discovery. While analyzing transportation data, he noticed that trucking industry contractions consistently preceded broader economic recessions by 6 to 18 months. His findings were initially dismissed by mainstream economists who considered trucking too small a sector to predict national trends. But Friedman's indicator proved eerily accurate. The 1973-1975 recession? Trucking rates started falling 14 months earlier. The 1980 recession? Truck bankruptcies surged 11 months before unemployment spiked. The 1990-1991 recession? Freight volumes collapsed 8 months ahead of the official downturn. The 2001 dot-com crash? Trucking companies began failing 13 months before the NASDAQ peaked. And the 2008 financial crisis? Freight rates started plummeting in late 2006, almost 2 years before Lehman Brothers collapsed. But here's what makes this indicator so powerful. It's not predicting recessions by looking at financial markets or consumer confidence. It's measuring something far more fundamental. Every single thing you buy, eat, wear, or use in your daily life moved on a truck at some point. When the economy starts slowing down, the first thing that happens is companies order less stuff. When companies order less stuff, there's less freight to move. When there's less freight to move, trucking companies start competing desperately for whatever business remains. This creates a cascading effect that destroys the trucking industry months before anyone realizes the broader economy is in trouble. Think about it like this. Imagine the economy is a massive machine, and trucking is the oil that keeps all the parts moving. When the oil pressure starts dropping, the machine doesn't break immediately. But mechanics know that oil pressure problems always lead to engine failure if you don't fix them fast. That's exactly what's happening right now. The DAT Freight Index, which tracks spot market rates for truckers, has fallen to levels not seen since 2009. Van rates, which represent about 65% of all freight, are down 28% year over year. Reefer rates have collapsed 31%. Even flatbed rates, traditionally the most stable, are down 19%. But the most terrifying number is the Cass Freight Index, which measures total freight volumes. It's been declining for 21 consecutive months as of October 2024. To put that in perspective, the longest previous decline was 19 months during the 2008 financial crisis. We're now in uncharted territory. Craig Fuller, CEO of FreightWaves and one of the trucking industry's most respected analysts, recently told CNBC something that should chill every American to the bone. What we're seeing in trucking right now is worse than 2008. The difference is that in 2008, we knew we were in a recession. Right now, we're in a freight recession, while everyone's celebrating economic growth. That disconnect is what makes this so dangerous. But the trucking indicator is just one piece of a much larger puzzle. Because when I started digging deeper into what's really happening in the American economy, I discovered something that connects the trucking crisis to a massive financial time bomb that's about to explode. And it involves the one thing that every American family depends on, but almost nobody understands. Jennifer Walsh seemed like the perfect example of American economic recovery. The 41-year-old marketing manager from Colorado had survived the COVID layoffs, gotten a promotion in 2023, and was finally feeling financially secure for the first time in years. Then her credit card statement arrived in September 2024. Her minimum payment had jumped from $847 to $1,394 overnight. I called thinking it was a mistake, Jennifer told me during our interview. The customer service rep explained that my variable rate had increased from 18.9% to 31.7% because of Federal Reserve policies. 31%. On debt I'd been managing responsibly for 3 years. Jennifer isn't alone. She's part of a $117 trillion consumer debt crisis that's about to devastate the American economy in ways that will make the trucking bankruptcies look like a warm-up act. Here are the numbers that should terrify every American. Total consumer debt hit $117 trillion in Q3 2024, an all-time record. Average credit card interest rates reached 24.9%, the highest in recorded history. Credit card delinquencies increased 79% year-over-year among consumers aged 30-39. Personal savings rates dropped to 3.4%, near historic lows. But here's what makes this crisis different from anything we've seen before. Previous recessions were caused by specific sector collapses: housing in 2008, tech stocks in 2000, savings and loans in 1990. This time, we're facing a perfect storm of interconnected disasters. The trucking industry is collapsing because consumers are buying less stuff. Consumers are buying less stuff because they're drowning in credit card debt. They're drowning in credit card debt because inflation forced them to borrow money to maintain their standard of living. And now, rising interest rates are making that debt impossible to service. Jennifer's story gets worse. After her minimum payment spiked, she tried to transfer her balance to a lower-rate card. Every application got rejected. Her credit score had dropped from 748 to 602 because her debt-to-income ratio had become too high. "I'm trapped," she explained, fighting back tears. "I can't pay off the debt because the payments are too high. I can't transfer it because nobody will approve me. And I can't stop using the cards because inflation means my salary doesn't cover basic expenses anymore." Jennifer is one of 47 million Americans currently carrying credit card debt. If even 20% of them face similar payment shocks, we're looking at a consumer spending collapse that would make the 2008 recession look mild. Let me show you exactly how this death spiral works. If you owe $8,000 on a credit card, the American average, at 31% interest, your minimum payment is roughly $267 per month. But here's the terrifying math. If you only make minimum payments, it will take you 94 years to pay off that debt, and you'll pay $83,000 in interest. 94 years, $83,000 in interest. On $8,000 of debt, that's not a credit card, that's financial slavery. But the consumer debt crisis connects directly back to our trucking indicator. When 47 million Americans are struggling with unpayable credit card debt, they stop buying everything except absolute necessities. When they stop buying stuff, there's less freight to move. When there's less freight to move, trucking companies fail. And when trucking companies start failing en masse, it means the broader economic collapse is just months away. But there's an even more sinister connection that most economists are missing. Because the same financial institutions that are jacking up credit card rates to 31% are simultaneously doing something with corporate debt that could trigger the largest bankruptcy wave in American history. And it's happening right now, in plain sight, while everyone's distracted by election coverage and stock market records. David Park ran a successful mid-size manufacturing company in Ohio. Park Industries employed 340 people, making automotive parts for Ford, General Motors, and Toyota. The company had survived COVID, supply chain disruptions, and labor shortages. Revenue in 2023 was strong, and the future looked bright. Then the refinancing notice arrived in March 2024. Park's $18 million business loan, which had been locked at 3.2% since 2019, was coming due. The bank's new offer, 11.7% interest, with significantly stricter collateral requirements. The monthly payment would go from $89,000 to $203,000, David explained during our phone call. There's no way any manufacturing company can absorb that kind of increase and stay competitive. We'd have to lay off half our workforce just to service the debt. David's situation is being replicated thousands of times across corporate America, creating what economists are calling the refinancing cliff, a $1.4 trillion wall of corporate debt that must be refinanced at much higher rates over the next 2 years. According to Federal Reserve data, approximately $1.4 trillion in corporate debt is scheduled to mature between 2024 and 2026. Most of this debt was issued during the ultra-low interest rate environment of 2010 to 2022, when companies could borrow money at 2–4% interest rates. Now those same companies are facing renewal rates of 8–12%, effectively tripling or quadrupling their debt service costs overnight. To put this in perspective, the entire subprime mortgage crisis of 2008 involved approximately $1.3 trillion in bad loans. We're now facing $1.4 trillion in corporate debt that may become unserviceable simply because of interest rate changes. This isn't a housing bubble or a tech bubble. This is a debt refinancing nuclear bomb. But here's what makes this crisis uniquely dangerous. When consumers default on credit cards, they hurt themselves and their families. When corporations can't refinance their debt, they destroy entire communities. Let me walk you through exactly how this works. Phase 1. Companies receive refinancing offers at impossibly high rates. Phase 2. They attempt to cut costs through layoffs and operational reductions. Phase 3. Reduced operations lead to lower revenues, making debt service even harder. Phase 4. Companies begin defaulting on loan payments. Phase 5. Banks tighten lending standards for all businesses. Phase 6. Healthy companies can't get credit to operate normally. Phase 7. Widespread business failures trigger mass unemployment. Phase 8. Unemployed consumers stop spending, creating a deflationary spiral. David Park tried everything to save his company. He laid off 89 employees in April 2024. He sold 2 pieces of manufacturing equipment. He negotiated payment delays with suppliers. He even took out a second mortgage on his personal home to inject cash into the business. None of it was enough. Park Industries filed for Chapter 11 bankruptcy in August 2024. All 251 remaining employees lost their jobs. 3 supplier companies that depended on Park's business also failed within 6 months. The ripple effects destroyed over 800 jobs in a town of just 47,000 people. I keep thinking about the families, David told me, his voice hollow. People who trusted me, who worked hard every day, who did nothing wrong except work for a company that got caught in an impossible financial situation. Park's story is being repeated across every industry. Retail companies, manufacturing firms, technology startups, real estate developers, all facing the same refinancing cliff with the same impossible choices. The Private Company Director magazine reports that 3,200 companies with revenues over $50 million filed for bankruptcy in the first 9 months of 2024. That's a 67% increase over the same period in 2023. But the real crisis is coming. According to Moody's Analytics, over 40% of the $1.4 trillion refinancing wave is scheduled for 2025. If current interest rates hold, they estimate that 15 to 20% of those companies will be unable to refinance their debt. That's between $210 billion and $280 billion in corporate failures over the next 18 months. But here's what makes this crisis different from 2008, and potentially much worse. During the 2008 financial crisis, the problem was concentrated in housing and financial services. Most of the broader economy remained relatively healthy. Manufacturing companies, retail businesses, and service industries were collateral damage, not the primary source of the crisis. This time, the debt bomb is scattered across every sector of the economy. When it explodes, there won't be healthy industries to cushion the blow. Everything will be failing simultaneously. And unlike 2008, the Federal Reserve has far less room to cut interest rates to stimulate recovery. With inflation still above target, they can't return to the zero-rate policies that enabled the post-2008 recovery. But the corporate debt crisis and the consumer debt avalanche are just two pieces of the economic disaster that's unfolding. Because there's a third element that connects everything together, something that's happening in plain sight but being completely ignored by mainstream economists. And when you see how all three pieces fit together, you'll understand exactly why the trucking recession indicator is screaming its loudest warning in over 50 years. Lisa and Mark Thompson thought they'd made the smartest financial decision of their lives in March 2021. The couple from Phoenix purchased their dream home for $485,000 with a 2.8% mortgage rate. By early 2024, that house was worth $720,000 according to Zillow. They had gained $235,000 in equity in just 3 years. Then they tried to sell. After 6 months on the market, 3 price reductions, and 0 serious offers, the house finally sold in September 2024 for $461,000, $24,000 less than they'd paid 3 years earlier. "We thought we were rich," Lisa explained during our interview. "Every month, Zillow was telling us our house was worth more money. We made financial decisions based on that equity. We took out a home equity line of credit. We bought new cars. We even talked about buying a vacation rental property. But when we actually needed to sell, we discovered that all that equity was just numbers on a screen. Nobody was willing to pay what the algorithm said our house was worth." The Thompsons learned the hard way what millions of Americans are about to discover. There's a massive difference between theoretical home values and actual market prices. Here's what's really happening in the housing market right now. Existing home sales have fallen 28% year over year as of October 2024. Average time on market has increased from 23 days to 67 days in most metropolitan areas. Price reductions are occurring on 43% of listings compared to 19% in 2023. Mortgage applications are down 31% despite population growth. But here's the paradox that's confusing everyone. Home prices, according to indexes like Case-Shiller, are still showing year-over-year gains, while actual transaction data shows a market in freefall. The explanation reveals a fundamental flaw in how we measure housing markets. Price indexes are based on completed sales, but they don't account for the fact that most homeowners simply won't sell at current market conditions. Dr. Elena Rodriguez, a real estate economist at the University of California, San Diego, explained it to me this way. Imagine if the stock market only recorded the prices that sellers were willing to accept, not the prices buyers were actually willing to pay. That's essentially what's happening with housing data right now. The root of the housing crisis is what economists call the mortgage lock-in effect. Approximately 62% of American homeowners have mortgage rates below 4%. With current rates hovering around 7.5%, moving would mean doubling or tripling their monthly housing payment. So they're not moving. They're staying in homes that might not fit their needs, in locations they might want to leave, because the financial penalty for moving has become prohibitive. This creates artificial scarcity in the housing market. Not because there aren't enough homes, but because homeowners are financially trapped in the homes they have. The effects are devastating for everyone involved. Young families can't find starter homes because current owners can't afford to move up. Job mobility has decreased dramatically because employees can't relocate without facing massive housing cost increases. construction companies are failing because demand for new homes has collapsed? Why build new inventory when existing inventory isn't moving? Local economies are stagnating because home sales drive spending on furniture, appliances, home improvement, and dozens of other industries. But here's the most dangerous part. The housing market paralysis is creating a deflationary spiral that most economists haven't recognized yet. When housing markets freeze up, several things happen simultaneously. Construction employment falls, reducing worker income and spending power. Real estate agents, mortgage brokers, and title companies see their income collapse. Home improvement retailers experience massive sales declines. Moving companies, storage facilities, and related services see demand evaporate. Furniture and appliance sales plummet because people aren't setting up new homes. All of these job losses and income reductions mean less consumer spending, which brings us full circle to why trucking companies are failing. There's simply less economic activity to transport. But the human cost goes beyond economics. Families are making life decisions based on financial constraints that shouldn't exist in a healthy economy. Jennifer Martinez, a nurse in Denver, has been trying to move closer to her elderly parents in Colorado Springs for 2 years. Her current mortgage payment is $1,147 per month at 3.1%. An equivalent home near her parents would cost $3,400 per month at current rates. "I'm missing my father's final years because I can't afford to move 50 miles, she told me, breaking down in tears. He has dementia, and every month that passes, he remembers less of who I am. But I can't sacrifice my family's financial future to be closer to him." The housing market freeze connects directly to both the consumer debt crisis and the corporate refinancing cliff. When people can't move, they can't access their home equity to pay down credit card debt. When companies can't relocate or expand, they can't grow their way out of debt problems. Everything is connected, and everything is breaking down simultaneously. But now, I need to show you how all three crises, trucking, debt, and housing, come together to create the perfect economic storm. Because there's a fourth element that ties everything together, and it's something that nobody saw coming. On March 8, 2024, Regional Banking Corp of Wisconsin announced they were optimizing their loan portfolio and focusing on their core market areas. The press release was filled with corporate buzzwords designed to sound positive and strategic. What it actually meant was that they were preparing for the largest loan default wave in the bank's 87-year history. Internal documents that I obtained through a source at the bank reveal the terrifying reality behind the corporate speak. RBC Wisconsin was sitting on $340 million in commercial real estate loans that were either in default or likely to default within 6 months. Their consumer loan portfolio showed delinquency rates of 8.7% compared to a historical average of 2.1%. The bank was insolvent. They just hadn't announced it yet. Regional Banking Corp isn't unique. They're representative of a crisis that's sweeping through America's community and regional banking sector. The institutions that provide 70% of all commercial lending and 45% of all residential mortgages. According to Federal Deposit Insurance Corporation data, 722 banks are currently on their problem list, meaning they're showing signs of financial distress that could lead to failure. That's the highest number since 2012. But the real crisis is hiding in their loan portfolios. When interest rates rise rapidly, as they have over the past 2 years, banks face a problem called unrealized losses on their securities portfolios. Essentially, bonds and other investments they purchased during the low-rate environment are now worth significantly less than what they paid. According to the Federal Reserve's latest bank stress tests, The American banking system is sitting on approximately $650 billion in unrealized losses. That's more than the entire GDP of Switzerland. But here's what makes this crisis different from 2008. It's not concentrated in a few large institutions that can be bailed out. It's spread across thousands of smaller banks that don't have the political clout or systemic importance to guarantee government rescue. When Regional Banking Corp finally collapsed in July 2024, it didn't make national headlines. The failure of an 87-year-old community institution didn't seem newsworthy compared to political scandals and celebrity gossip. But for the 23,000 customers who had accounts there, it was devastating. Small businesses that had banking relationships spanning decades suddenly found their credit lines frozen. Farmers who needed seasonal operating loans were told to find new lenders. Families discovered that their home equity lines of credit had been terminated overnight. Maria Santos, who owns 3 small restaurants in Wisconsin, lost access to $180,000 in business credit when RBC failed. 23 years I banked with them, she told me. My father started his account there in 1987. They knew our family, they understood our business cycles. They worked with us through tough times. Now I'm dealing with some giant bank in Chicago that sees me as a number on a spreadsheet. They want collateral I don't have, documentation that doesn't exist, and credit standards that no small business can meet. Maria had to close one of her restaurants because she couldn't get the working capital loan she needed for the holiday season. 16 people lost their jobs. The banking crisis connects to every other element of our economic collapse. Banks are failing because their loan portfolios are deteriorating due to the corporate debt refinancing crisis. They can't make new loans because their capital is tied up in unrealized losses from rising interest rates. Without access to credit, businesses can't operate normally, which reduces freight volumes and kills trucking companies. Consumers can't get home equity loans to pay down credit card debt because banks are limiting lending. The housing market stays frozen because buyers can't get mortgages and sellers can't find bridge financing. You might be wondering, where are the federal banking regulators? Why isn't the government stepping in to prevent this crisis? The answer reveals the most disturbing aspect of our current situation. Federal banking regulators are fully aware of the crisis. The FDIC's quarterly banking profile shows deteriorating loan quality, declining profitability, and increasing numbers of problem institutions. But they're choosing not to act aggressively because acknowledging the scope of the problem would trigger the very panic they're trying to avoid. It's a classic catch-22. They can't solve the problem without admitting there is a problem. But admitting there's a problem would make the problem worse. So they're hoping it resolves itself before public awareness creates a crisis of confidence. This brings us to the terrifying conclusion that connects all 4 elements of our economic crisis. The trucking recession is signaling reduced economic activity. The consumer debt avalanche is eliminating spending power. The housing market freeze is preventing normal economic mobility and wealth access. The banking crisis is choking off the credit that businesses need to survive. When you connect all 4 crises, the picture becomes clear. We're not heading toward a recession. We're already in one. The official statistics just haven't caught up to reality yet. Now I need to show you exactly how this plays out over the next 18 months. Because the timing matters more than most people realize. Based on historical patterns of the trucking recession indicator, combined with the debt refinancing timeline and banking sector deterioration, here's the most likely scenario. Phase 1, November 2024, February 2025, the quiet crisis. We're currently in this phase. Banking sector stress continues building while trucking bankruptcies accelerate. consumer spending begins declining sharply during the typically strong holiday season. Official statistics still show economic growth, but leading indicators are flashing red across the board. Phase 2. March 2025, June 2025, the refinancing cliff. Corporate debt refinancing peaks during this period. Expect massive waves of business bankruptcies as companies discover they can't afford new loan terms. Unemployment begins rising sharply as businesses eliminate positions to cut costs. The housing market experiences a sharp decline in values as distressed sales increase. Phase 3. July 2025, October 2025, the banking collapse. Regional bank failures accelerate as commercial loan defaults reach crisis levels. Credit availability disappears for small and medium businesses. Consumer spending collapses as unemployment spikes and credit card companies slash credit limits. The recession becomes official and undeniable. Phase 4. November 2025, February 2026, the deflationary spiral. Asset prices across all categories begin declining rapidly. Housing, stocks, commodities, and even collectibles lose value as forced liquidation becomes widespread. Government attempts to stimulate the economy face the constraint of high inflation, limiting their effectiveness. Now, before you panic, I need to tell you something important. This timeline isn't inevitable. Economic predictions are educated guesses based on current trends, not certainties. There are several factors that could change this trajectory. If the Federal Reserve pivots to dramatically lower interest rates, it could provide relief for the refinancing crisis. If Congress passes targeted legislation to address the banking sector's stress, it could prevent the cascade of regional bank failures. If global economic conditions improve significantly, it could boost demand and help the trucking sector recover. If inflation falls faster than expected, it could give consumers more spending power despite their debt burdens. However, the probability of all these positive factors aligning is relatively low. More likely, we'll see some improvements in certain areas that slow down the crisis timeline rather than preventing it entirely. The trucking recession indicator has been accurate for over 50 years. Ignoring its warning because we hope for the best would be financially irresponsible. So what can you do to protect yourself and your family during this economic transition? First, reduce your debt exposure immediately. If you have variable rate debt, try to refinance to fixed rates now, before the banking crisis makes credit unavailable. Pay down credit card balances aggressively, even if it means reducing your savings temporarily. Second, build cash reserves. In deflationary environments, cash becomes increasingly valuable as asset prices fall. Aim for 12 to 18 months of expenses in readily available funds. Third, avoid major financial commitments. Don't buy a house, start a business, or make large investments until the economic situation stabilizes. Flexibility will be more valuable than optimization over the next 2 years. Fourth, focus on recession-proof skills. If you're employed, develop capabilities that would be essential even during economic downturns. If you're a business owner, pivot toward products or services that people need, regardless of economic conditions. Fifth, stay informed, but don't panic. Monitor leading indicators like the ones we've discussed. But don't make emotional decisions based on daily news cycles. Economic transitions take time to unfold, and preparation is more important than prediction. What we're witnessing isn't just an economic cycle. It's the consequence of decades of financial decisions that prioritized short-term growth over long-term stability. The ultra-low interest rate environment that began after 2008 created massive distortions throughout the economy. Companies borrowed money they couldn't afford to pay back at normal rates. Consumers took on debt loads that were only sustainable in a zero-rate world. Asset prices inflated to levels that had no relationship to underlying economic value. Now the bill is coming due. The trucking recession indicator is so accurate because it measures real economic activity, not financial engineering. You can manipulate stock prices. You can massage employment statistics. You can use accounting tricks to make debt problems disappear temporarily. But you can't fake freight volumes. When people and businesses stop buying stuff, there's less stuff to transport. It's that simple and that reliable. The current crisis is unique because it's happening simultaneously across multiple sectors that are usually independent. Housing, banking, corporate debt, and consumer spending are all experiencing stress at the same time, creating a systemic risk that's larger than the sum of its parts. The last time America faced a crisis of this scope was the 1970s, when inflation, unemployment, and interest rates all spiked simultaneously. The recovery took nearly a decade and required fundamental changes to monetary policy, financial regulation, and economic management. This time could be different, potentially better or potentially worse. We have more sophisticated financial tools and better economic understanding than we did in the 1970s. But we also have much higher debt levels, more complex financial systems, and global interconnections that didn't exist 50 years ago. The question isn't whether this crisis will unfold. The question is whether you'll be prepared when it does. The silent recession indicator has spoken, and its message is unmistakable. The American economy is heading toward a downturn that will be more severe and longer lasting than anything we've experienced since 2008. The trucking industry collapse, consumer debt avalanche, corporate refinancing cliff, and banking sector stress are all pieces of the same puzzle. They're not separate crises that might occur. They're interconnected elements of an economic transformation that's already underway. Think back to Sarah Chen, the trucking company owner who lost her family's 3-generation business. To Jennifer Walsh, trapped by credit card debt that's growing faster than she can pay it. To David Park, who watched his manufacturing company collapse despite doing everything right. To Lisa and Mark Thompson, who discovered their home equity was just a number on a screen. These aren't statistics or abstract economic indicators. They're real people whose lives have been disrupted by forces beyond their control. Their stories are previews of what millions of Americans will experience over the next 2 years. But here's what gives me hope. Americans have survived worse crises and emerged stronger. The Great Depression, World War II, the 1970s stagflation, the 2008 financial crisis. Each time, people adapted, innovated, and rebuilt better systems. This economic transition will be painful, but it's also an opportunity. Recessions clear out inefficient businesses and create space for better ones. They force people to develop new skills and find new opportunities. They remind us what's truly valuable when artificial wealth disappears. The key is understanding what's happening and preparing accordingly. Don't be like the executives who ignored the trucking indicators because the stock market was hitting records. Don't be like the families who assumed rising home values would continue forever. Don't be like the business owners who thought cheap money would always be available. The warning signs are clear. The timeline is predictable. The outcomes are manageable if you prepare now. What you do with this information is up to you. What do you think about these recession indicators? Are you seeing similar warning signs in your industry or community? Drop your thoughts in the comments below. I read every single one, and your insights help inform future videos. If this economic analysis opened your eyes to what's really happening behind the headlines, smash that like button and subscribe to FinSight Capital. We're committed to bringing you the financial truths that mainstream media won't discuss. With a deep analysis, you need to protect your wealth and plan for the future. And if you think this economic crisis is shocking, wait until you see what we're covering next week. We've uncovered evidence of a massive financial scandal that makes the 2008 subprime crisis look like a minor accounting error. The story involves three major banks, $847 billion in hidden losses, and a cover-up that goes all the way to the Federal Reserve. Click here to make sure you don't miss it. Because when this story breaks, it's going to change everything you think you know about the American banking system. Thanks for watching, and remember, in the world of finance, knowledge isn't just power, it's survival.